Hello all, welcome back to our channel. Today we are diving into the world of ratio analysis, which is a crucial tool for understanding a company's financial health. In this video, we will explore liquidity ratios which help us to assess a company's ability to meet its short-term obligations. So let's get started. First, let's talk about what ratio analysis is and why it is important. Ratio analysis involves calculating and interpreting various financial ratios from a company's financial statements. These ratios provide insights into different aspects of a company's performance, such as liquidity, leverage, activity, and profitability. By understanding these ratios, investors, managers, and analysts can make informed decisions. Now let's focus on liquidity ratios. These ratios measure a company's ability to pay off its short-term liabilities with its short-term assets. We will cover 5 key liquidity ratios: the current ratio, the quick ratio, the cash ratio, the basic defense interval, and the net working capital. Let's start with current ratio. The current ratio is calculated as current assets divided by current liabilities. It shows how well a company can cover its short-term obligations with its short-term assets. But what exactly are current assets and current liabilities? Current assets include cash, accounts receivable, inventory, and other assets that are expected to be converted into cash within a year. Current liabilities are obligations that the company needs to pay off within a year, such as accounts payable, short-term debts, and short-term liabilities. For example, if a company has a current assets of rupees 1,50,000 and current liabilities of rupees 1 lakh, the current ratio would be 1.5. This means that the company has 1.5 rupees in current assets for every 1 rupee current liabilities. An optimal current ratio is typically between 1.5 and 2, indicating good liquidity. Now let's try a practical problem. A company has a current assets of 2 lakhs and the current liabilities of rupees 1,25,000. Now calculate the current ratio and interrupt the results. The current ratio is 1.6, meaning the company has rupees 1.6 in current assets for every 1 rupee of current liabilities. A ratio of 1 indicates good liquidity. Now let's consider a negative example. If a company has a current assets of 80,000 and current liabilities of 1 lakh, the current ratio would be 0.8, indicating potential liquidity issues. Let's dive into quick ratio. It is also known as acid test ratio. This ratio excludes inventory and prepaid expenses from current assets and is calculated as current assets minus inventory minus prepaid expenses divided by current liabilities. Inventory and prepaid expenses are excluded from the quick ratio because they are not as easily converted to cash as other current assets. This provides a more stringent measure of company's immediate liquidity by focusing on the most liquid assets. Let us consider an example for understanding quick ratio. For instance, if a company has current assets of rupees 1,50,000, inventory of rupees 50,000, prepaid expense of rupees 10,000, and current liabilities of rupees 1 lakh. Now if you calculate the quick ratio would be 0.9. This means the company has 0.9 rupees in liquid assets for every 1 rupees of current liabilities. An optimal quick ratio is typically around 1, indicating sufficient liquidity without relying on inventory. Now for a negative example, if a company has current assets of rupees 1 lakh and inventory of 40,000, prepaid expense of rupees 10,000 and current liabilities of 1 lakh, the quick ratio would be 0.5, indicating potential liquidity issues. The next ratio is cash ratio. It measures a company's ability to pay off its short-term liabilities with its cash and cash equivalents. It is calculated as cash and cash equivalents divided by current liabilities. For example, if a company has a cash and cash equivalents of rupees 80,000 and current liabilities of rupees 1 lakh, the ratio would be 0.8. This means the company has 0.8 rupees in cash for every 1 rupee of current liabilities. An optimal cash ratio is typically around 0.5 to 1, indicating a conservative measure of liquidity. For a negative example, if a company has a cash and cash equivalents of rupees 40,000 and current liabilities of rupees 1 lakh, the cash ratio would be 0.4, indicating the potential liquidity issues. And the next one would be basic defense interval. It is also known as interval measure ratio. This ratio measures how many days a company can operate using only its liquid assets. It's calculated as current assets minus inventory divided by daily operating expenses. For example, if a company has a current assets of rupees 2 lakhs and inventory of rupees 50,000 and daily operating expenses of rupees 5,000, if we calculate, basic defense interval would be 30 days. This means the company can operate for 30 days using only its liquid assets. An optimal basic defense interval varies by industry but generally ranges from 30 to 90 days. For negative example, if a company has current assets of rupees 1 lakh, inventory of rupees 30,000 and daily operating expenses of rupees 10,000, the basic defense interval would be 7 days, including potential liquidity issues. And finally, we have net working capital, which means the difference between current assets and current liabilities. It is calculated as current assets minus current liabilities. For example, if a company has current assets of rupees 1,50,000 and current liabilities of rupees 1 lakh, the net working capital would be rupees 50,000. Positive net working capital indicates that a company can cover its short-term obligations, while negative net working capital indicates potential liquidity issues. Let's look at a practical example. A company has current assets of rupees 2,50,000 and current liabilities of 2 lakhs. Calculate the net working capital and interrupt the results. The net working capital would be 50,000, indicating the company can cover its short-term obligations. For a negative example, if a company has a current assets of rupees 80,000 and current liabilities of rupees 1 lakh, the net working capital would be minus 20,000, indicating potential issues. That's it for today's video on liquidity ratios. We hope you found this explanation helpful and engaging. Don't forget to like, share, and subscribe for more financial insights. And let us know in the comments if you have any questions or topics you would like us to cover next. Thanks for watching.